Well, for more than 2 years, gold has been a winning trade for investors. The price of gold has soared by more than 70% over that period, driven by numerous factors, including weakness in the U.S. dollar and uncertainty driven by U.S. tariff policies. But earlier this week, a Wall Street expert made a dramatic and bearish call. He says the rally is close to being over and predicts that gold will be trading at about $2,500 to $2,700 U.S. dollars per ounce in the second half of next year, about $900 or so less than the number you see on your screen. We're now joined by the person who made that call. Max Layton is the head of global commodities at Citi Research, and he joins us right now. Max, thanks a lot for joining us. Your call got a lot of attention. Of course, we get a lot of calls on gold and gold stocks on this channel. Tell us why you've made the call. And I'll tell you, Max, that we do have a couple of your graphs ready to show viewers when you think it's the right time to do so. We've got the graph on new gold and supply balance, demand balance, new gold supply and demand balance. We've got that ready to go. And we've got the graph on high cost gold miners' margins ready to go when you think it's the right time. You tell us, Max, why you've made this call.
Yeah, thank you. Thank you very much for having me. So yeah, look, as you said, we've been bullish on gold for the last couple of years. And, you know, it got to the point where people were starting to extrapolate that bullishness kind of indefinitely and to what I consider extreme levels. And we wanted to evaluate, you know, how high gold could go. And you know, what we've found in that work, we've established this physical fundamental framework for gold pricing, which works really well at explaining the price for the last 50 years. And what we learned from that is central banks are only a tiny part of this story, and they're certainly not the primary driver of the strength this year. The move from $2,600 up to $3,300 this year has been all about investors buying bars and coins, particularly bars, because they're hedging against downside in US and global growth, as well as downside in equities related to that downside in US and global growth, which, has really come about because of the combination of still extremely high interest rates in the US by historical standards and the tariffs. And so the combination of these factors has meant that investment demand fear around a deterioration in global growth is extremely high right now. So what are many, essentially people are buying gold to hedge against the downside risk to their household wealth. It's typically the wealthy that are doing this. Global wealth's about $500 trillion, and they're allocating some of that $500 trillion into gold. And, our call is, the reason why we're making it now is we're getting close to this One Big Beautiful Bill Act passing Congress. So what we think that's going to mark a shift in sentiment towards U.S. growth and basically a slight reduction or even a moderate reduction, or even possibly by the end of next year heading into the midterms with lower interest rates as well. This bill, the passing of it being net stimulatory for the U.S. economy, is going to reduce fears about growth and lead to a bit more positivity and a little less investment buying of gold. And with that, you basically unwind the primary driver of the last $700 move in the gold price higher from $2,600 to $3,300. You unwind the vast bulk of that, I think. That's the core of it.
So Max, I guess I would say, or my question to you would be, do you think the U.S. market, the U.S. economy, is going to have a move higher? And if so, will the U.S. dollar follow? I guess your premise is that people have been buying based on fear, or at least as a hedge against the U.S. market, U.S. dollar. Do you believe that on the flip side, if you're an investor, you move out of gold and maybe into the equity markets? Are you thinking that the U.S. market rises now, and that's what's going to put pressure on the price of gold?
Yeah, what I think is that President Trump has moved to do the things that he can do in terms of closing the border, in terms of the tariff policies and the tariff implementations that he has been able to do, and he's moved to do these things. And the second one, the tariffs, has been, has been and will continue to increase uncertainty and place downward pressure on global growth. in the near term, and that's going to keep gold prices high in the short term. So our call is very much a 2026 bearish gold call. Near term, we have it averaging around 3,200 in the third quarter, 3,000 in the fourth quarter. And I think, the view is actually not out of consensus. In 2026, the vast bulk of our competitors, or at least the ones I'm aware of, also see a little bit of a growth recovery, things improving in 2026 once we get through the tariffs, once this bill's passed, which is net stimulatory. People are a little bit more bullish on 26, and with that, on growth, there should be slightly less fear. Just to put, an exclamation point on the degree of fear at the moment, the gold buying, the amount of money that we're spending as a planet on gold right now at current prices is about roughly 0.5% of GDP. So we're spending about 0.5% of GDP on gold right now, which is the highest in 50 years. We have about 50 years of data, which includes the second oil shock and the massive gold boom back in 1980. And so, that's just kind of a reflection of the fact that, there's a broad suite of things that people are worried about now. Debasement, deterioration, debasement in the US currency, debasement in the Chinese currency, deterioration of global growth and U.S. growth. And yeah, I think I was starting to say Trump's done a lot of the things he can do without Congress, but he has a lot of things that are coming down the pipe that he can do to turn things around. And I think into the midterms, President Trump's going to try to do that. And that's, balance of risks. It's probably going to be bullish and, not next quarter, but towards the end of this year into 2026. And that's going to see gold pull back.
Okay, let's show viewers some of the charts and graphs in your report. The first one that we'll put up on the screen is the one that shows the global supply and demand balance from 2010 through to the present day. So on the left-hand side of the screen, we see the gold price. The line on the graph actually refers to the right-hand side of this graph, which is measured in tons. So we're seeing the balance of global supply and demand measured in tons. Tell us what this is showing us, Max.
Yeah, so first of all, this is Citi's estimates of the balance. In the gold reporting, the supply side is reported as gross supply. In the reporting by the World Gold Council and their data sources, the demand side is reported as net demand, most of the demand side. So it's net, it's gross jewelry demand but and gross industrial, but it's net investment demand, so net central bank, net ETF. In any case, in our supply-demand balance, we try to scale up the net investment demand to get a gross number based on industry anecdotes. And when we do that, it reveals this supply and demand balance.
Okay, and the next one is the profit margins at high-cost gold miners, and it has absolutely soared. I guess a higher price of gold boosts the margins even at producers of gold who are higher cost. Explain this one to us, Max. It's up on our screen right now.
Yeah, so because investment demand and jewelry demand is so strong, gold prices have had to go up to incentivize stockholders to sell to fill the deficit that was on the last chart. It's the biggest deficit since 2020. And that high price, together with a high interest rate, which, the gold forward curve is essentially tied to the interest rate. So you got a high spot price around 33.80 at the moment. The 5-year forward gold price is trading almost 20% higher at about $4,000 an ounce. That's because the interest rate is about 4% per annum over the next 5 years. About 20% higher takes you to 4,000. So the producers, should they choose to lock in these forward prices, they would be earning as big as a 100% margin on the 5-year forward, or slightly less than that on the nearer dated forwards. And this is the highest producer margins, whether you use the forwards or spot, that we've seen in 50 years. This is one remarkable gold bull market, absolutely astonishing. And, we don't call the top in it lightly.